Hello all the CA Inter students, hope you have written your advanced accounting paper well, even if you didn't write well or you could not complete the paper. Do not think about the past papers, always think about what best you can do in the upcoming papers. In this video, I am here with a quick update on all the answers of part A of advanced accounting paper. You check these answers. The reason that I'm giving the answers in between the exams is that if at all you have done any silly mistakes, you will not continue those mistakes in the next papers. As we are aware, in next papers also we have part A. So if at all you feel any silly mistakes you have done here, please be more careful in the next exams. So let us get started with the case scenario number 1. Coming to case scenario number 1, in this case scenario there are almost 4 to 5 accounting standards which are covered. Especially in the initial part they are speaking about foreign exchange and all that, which is spoken in AS 11, and then we have the concept of related party relationship that is said under AS 18, and I see material, labor and all this which is part of AS 2, and in the last part of the standard we have the discussion of AS 29. Okay, let us first always understand that we will read the questions before we can read the case study. The first question they are asking about how much will be the borrowing cost as per AS 16. Okay, we'll answer that. And they are also asking how much would be exchange different that will be dealt as per AS 11. The next thing is they're asking about related party relationship, and they're asking about how much is the value of unsold finished toys. That means they're talking about closing stock. And in the last they are asking about how much provision and how much contingent liability we need to create. So let us read the case study. So here quickly I will go through the case study. P Limited has borrowed 1 lakh US dollars at the rate of 5%, means they are borrowing in USA. 5% is the interest rate, and when they have borrowed the exchange rate is 75, and by 31st March the exchange rate has become 80. Okay, so let us understand and that if the money would have been borrowed in India, the interest rate would have been 10%. Okay, I think we can answer the first question. They're asking how much is the amount of borrowing cost that should be recognized as per AS 16. Okay, so we know there is a concept how much interest you will pay since you have borrowed $1 lakh. $1 lakh into exchange rate is 80, that you will pay on 31st of March into 5%. So actual borrowing cost 4 lakhs is actually borrowing cost that you have paid. But there is a provision, sir. If at all you would have borrowed the same money in India, the interest would have been 1 lakh into 75 into 10%. Interest would have been 7,50,000. But you paid interest only of 4 lakhs. So you tried to save the interest of 3,50,000. But in the process of saving 3,50,000 of interest, there is an exchange loss, foreign exchange loss, because when you borrowed, it was 75, but this 75 has now become 80. So can I say it is a loss for us? Yes. How much the foreign exchange loss? 1 lakh into 5 rupees per dollar. 5 lakhs is the total exchange loss. But there is a provision in AS 16 that total 5 lakh will not be treated as loss. Out of 5 lakhs, how much have you tried to save interest? 3,50,000, because if you would have borrowed the same amount in India, the interest would have been 7,50,000, whereas you incurred an interest of only 4 lakhs. So you tried to say how much? 3,50,000. In order to save 3,50,000, you incurred a loss of 5 lakhs. So what AS 16 says is out of this 5 lakhs, it is not considered as loss. 5 lakhs is not loss. Out of 5 lakhs, 3,50,000 is deemed borrowing cost, and remaining 1,50,000 will be dealt as per AS 11. I think with this clarification we'll be able to answer two questions. What are they first asking? How much is total borrowing cost? Total borrowing cost will be actually how much you paid. Actual borrowing cost paid is 4 lakhs, and the deemed borrowing cost is 3,50,000. Total borrowing cost will be 7,50,000. Okay, so the first answer would be how much is what would be the amount of borrowing cost to be recognized? So it should be 7,50,000. The answer is 7,50,000. What is the next one? Okay, we got a total loss of 5 lakhs. Out of total loss of 5 lakhs, we understood that 3,50,000 is treated as a borrowing cost. So this is not covered under AS 11. Balance of 1,50,000 only will be dealt as per AS 11. So how much will be the foreign exchange difference as per AS 11? It will be 1,50,000. Chalo, next one. What is the relationship? For that we need to read the case study. P, P Limited holds 12% of voting in G Limited. That will not give any control or significant influence. But G Limited comprises of 8 members. 2 of these members are appointed by P Limited. So P Limited is deciding 2 board of directors out of 8, which is giving them significant influence. And as we know, as per AS 18, if any company has significant influence in another company, they are called as our associates. So here G Limited is an associate of P Limited. So what is the question that they are asking? What is the relationship of G Limited with P Limited? Very simple. G Limited is an associate of P Limited. So the answer would be B. Next, determine the value of unsold finished toys. Unsold in the sense we are speaking about closing stock. Here they have given the cost of material, labor and all of those things. Here I have done the working for you. If you check, material cost is 200, labor cost is 400 and the variable overhead is 20. But whereas fixed, the plant has a capacity to produce 1 lakh units and total fixed overheads is 15 lakhs. But please tell me how many units have you manufactured? 1 lakh 20. As we know, as per AS2, when your actual production is more than expected, allocation of fixed overhead will happen on the base of actual. So fixed overhead per unit will be 15 lakhs, not divided by 1 lakh, it will be divided by 1 lakh 20, which will be 12.5. So total cost per unit will be 272.5. And how much closing stock we have? We have closing stock of 11,000 units. So it will be 11,000 into 272.5. That will be 29 lakhs 97,500. Guys, please be very careful. If you would have done a very small mistake, material 200, labor 40, variable overhead, there is no mistake in this. But fixed overhead, if you would have taken 15 lakhs divided by 1 lakh, that is 15 per unit, which is wrong, which will be 275. 11,000 to 275 will be 30 lakhs 25,000, which is a wrong answer. Right answer will be 29 lakhs 97,500. So what will be the value of closing stock? So the value of closing stock will not be 30 lakhs 25,000. It will be 29 lakhs 97,500. Chalo. Let us get into the next one. They are asking about AS 29. Let us read what they are expecting. P Limited also renders catering services at various events. Okay, at a wedding in 24-25, which it had given its catering service, 10 people died because of possibly a result of food poisoning. So opposite people have started with legal proceedings were started by the client against P Limited seeking compensation of 10 lakhs. But it disputes the liability, means it is not yet finalized. They have filed a case. That does not mean that is sure shot of food poison and we have to end up paying 10 lakhs. The legal counsel of P Limited has advised that company is likely, it is just likely 50-50, it is not more likely. When it is more likely to lose, then we create a provision. When it is possible, then we treat that as a contingent liability. It is just likely, it is not more likely. Okay, the estimated liability is legal cost to be incurred is 75,000. So this cost of 75,000 has to be incurred. So for that 75,000 we need to create a provision, and I think for this 10 lakhs it is possible because it is not more likely. We have to create a contingent liability. So the answer would be we have to create a provision of 75,000 and make a disclosure of contingent liability, that will be 10 lakhs. Hopefully this case study was clear for everyone. Now let us get into the second case study. Second case study has multiple concepts, like we have the concept of AS7, then we have the concept of AS23, then we have the concept of AS25, which talks about interim financial reporting, and we have the concept of AS22. Again, this case study is based on multiple standards. So let us quickly understand what they're asking. Let us quickly read what the questions are they asking. They are asking the first question on AS7. This is a question on AS7. This is a question on AS23. This is a question on AS25, which talks about interim financial reporting, and the last one is about AS22. Okay, let us quickly answer them. Okay, first one, what are they asking? How much is the contract revenue and the total expenses to be recognized? in the statement of P&L as per the provision of AS7. Let us read the first part. We Limited entered into a contract to construct a hostel at an agreed value of 224 lakhs. So total contract revenue is 224. The expected completion time is 18 months. So it's a long-term contract. We Limited incurred a cost. Cost incurred up to date is 60, and estimated future cost is 180. So the total cost, first, as I've said, we should always check whether it is a profit making contract or a loss making contract. And I see it's a loss making contract because total cost is 80 already incurred plus 180, total is 240, whereas contract revenue is only 224. So it's a loss making contract. In case of loss making contract, we have to be careful. Let it be a profit making contract or loss making contract. First step, we have to calculate percentage of completion, that is cost incurred up to date divided by total cost into 100. So the percentage of completion in the first year is 25%. So how much will be the contract revenue of first year? How much you have billed does not matter. Billing is has least importance in AS7. So total revenue will be 224 into 25%, that is 56. This is the total revenue, and the cost will be as given, it will be 60. So, but since it's a loss making contract, we have to be little more careful. Contract revenue is 224, cost is 240, total loss is 16. But in this year, how much loss are we recognizing? 60 minus 56, 4 we have already recognized. So for future loss of 12, we need to create a provision. So how much provision are we going to create? 12. So total loss will be how much? 60. So total contract cost is 60, loss will be 16. So total will be 76. So coming to this answer, what are they asking? How much is the revenue and how much is the expense? Revenue will be 56 and expense they mean to say cost is 60, loss is 16, total will be 76. And some people, I think they should also give marks for this B, because revenue is 56 and expense means only cost. If they consider this, they should give for B also, but more appropriate answer would be C. Expense means the cost plus loss. Cost is 60 and the loss being 16, total will be 76. Okay, coming to the next part of the case study. On 1st June 24, We Limited acquired 30% in the sense associate, and that will be covered under AS 23 for a consideration of how much? 20 lakhs. Such acquisition enables a significant influence. M Limited declared a dividend of 5 lakhs out of profit of 8 lakhs earned by it in 31st March 20. Guys, very simple. You are purchasing in June 24. They are paying dividend related to 31st March 24. Can I say it's a pre-acquisition dividend? Yes. And further, they reported an earnings of 30 lakhs for the year ended 35. This is post-acquisition profit. How much is post-acquisition profit? 30 lakhs. But we are the owners only from June. So we are going to get dividend only for 10 months. So let us understand what is the question that they are asking. They are asking what will be the carrying amount of investment as on 31st March 25. It will be very simple. How much it would be is total cost of acquisition is 20 lakhs. Pre-acquisition dividend, that is 5 lakhs they are paying, we are going to receive 30%, 1,50,000. This will be the value as on 31st March 2024, but they are not asking as on 31st March 24. They are asking as on 31st March 25. So it will be pre-acquisition profits by an amount of post-acquisition profits. Your investment value is going to increase. Wow. So how much is post-acquisition profit? 30 lakhs into 30% for a period of 10 months. So it will be 7,50,000. So total value of investment as on 31st March 25 would be 26 lakhs. So the answer would be 26 lakhs. Chalo. What is the next thing that they are asking? Current tax expense to be reported in the second quarter. Okay guys, here they have given quarter 1 is 7 lakhs income, 2 is 8 lakhs, and in third quarter they are expecting 4 lakhs, and in fourth quarter they are expecting 6 lakhs. On first 5 lakhs the rate is 30%, and on additional earnings it is 40%. But guys, we know whenever slab rates are given, we need to calculate something called as weighted average tax rate. So if here I have done the working for you, quarter 1 it is 7 lakhs, quarter 2 8 lakhs, quarter 3 4 lakhs, quarter 4 6 lakhs. Since it is more than 5 lakhs in second quarter, we can't directly apply 40%. We need to calculate something called as weighted average tax rate. So how much is total estimated income? 25 lakhs. Let us calculate the tax on that. On first 5 lakhs, 30%, which gives an amount of 1 lakh 50,000. On remaining 20 lakhs, it will be 40%, that will be 8 lakhs. So estimated total tax will be 9 lakh 50,000. On 25 lakhs of income, you are paying a tax of 9 lakh 50,000. So let us calculate a percentage. The weighted average tax rate is 9 lakh 50 divided by 25 lakhs into 100, that is 38%. So in second quarter, tax expense will be, second quarter income is how much? 8 lakhs. 8 lakhs, you cannot apply 40%, you have to apply weighted average tax rate, that is 38%, which will give an amount of 3 lakhs 4,000. So how much will it be? 3 lakhs 4,000. Wonderful. Let us now come to the ninth question. What is ninth question? They are assuming tax rate is 30%, whether we have to create DTA or DTL. Chalo. Let us see what are the differences they have given. Accounts is allowing a depreciation of 4 lakhs. Tax is allowing a depreciation of 10 lakhs. So guys, can I say one thing, that accounts is allowing only 4 lakhs, tax is allowing 10 lakhs. So accounting income will be more by 6 lakhs. When accounting income is more, we create deferred tax liability. So 6 lakhs into 30% will be 1 lakh 80,000 of deferred tax liability. Next, coming to the next one, unamortized preliminary expense as per tax. Who is not allowing? Tax is not allowing. So taxable income is more by how much? 30,000. By 30,000, taxable income will be more. When taxable income is more than accounting income, we create DTA. On 30,000 into 30%, 9,000 DTA. So 1,80,000 of DTL and 9,000 of DTA. Next, coming to the last point, guys, many people would have done the mistake here. Penalty imposed by GST department is 1,25,000, but payable in which month? 30th April 25. But they are speaking about 31st March 25. Since this amount is not yet paid, there will not be any difference between accounting income and taxable income. So we should not consider this point. So the net answer would be DTL of 1,80,000 and DTA of 9,000. Net answer will be 1,71,000 deferred tax liability. So we have to create a deferred tax liability of 1,71,000. Chalo. Coming to the last one. Before we answer the last question, okay, I think it's an independent question. Let us directly answer this. PQR Limited is a manufacturing company that has several subsidiaries and a joint ventures. During the financial year, it sold a machine worth 2 crores to one of the subsidiary at arm's length price, and does not matter if there is a transaction between related parties, we have to disclose irrespective of whether it is at arm's length price or not. The company also paid remuneration to its CEO and CFO. Additionally, they received a loan of 1 crore from holding company. So there are a couple of transactions like selling the machinery, paying remuneration and receiving the loan. So what are they asking? Which of the following statements correctly reflect the application of AS 18? Very simple. AS 18 requires disclosure of related party transactions such as sale of machine, loans and managerial remuneration. Even if it is at arm's length price, AS 18 says you have to disclose once there is a transaction, let it be sale, receiving the loan or paying the remuneration, whatever kind of transaction, if it is between the related parties, we have to end up disclosing. Now let us get into the last case scenario quickly. Then you can cross check your answers. Okay, here case scenario number 3 is completely based on cash flow. It is completely on AS3. No other standard is involved. Okay, here they clearly gave that it is an indirect method that they are following. That means we are going to start with net profit, and here they have given net profit before tax. How much is net profit before tax? 22 lakhs. So I have taken net profit before tax 22 lakhs. Depreciation being a non-cash expense, that should be added. Amortization also 1,50,000 non-cash expense, that also should be added. Next, during their accounts receivable, that is working capital changes, current asset is increasing. If current asset is increasing, that should be deducted, 3,70,000. Then again, inventory is also increasing by 1,60,000, that also should be deducted. Accounts trade payable is increasing. If trade payable is increasing, we have to add it, 1,85,000. Next, the company also paid interest. If interest is paid, that is a non-operating activity, but they would have deducted this in P&L. Now we need to add it back. And how much income tax is paid? 2,40,000. Being an operating expense, we have to deduct. So how much is the operating activity? Answer: operating activity is 23 lakhs. And in this question, they have not given any investing activities. Only next paragraph is related to financing activity. Coming to financing activity, they issued shares. Issue of shares, how much? 9 lakhs. Issue of shares, 9 lakhs inflow. Next, also raised a long-term loan. Long-term loan is also operate as a financing activity. And apart from this, they have repaid debt. How much debt have they repaid? 3,50,000. So repayment of debt is also financing activity. Repayment of debt of 3,50,000. And apart from that, they also paid a dividend. How much dividend have they paid? 90,000 dividend they paid. So payment of dividend is also financing activity. And apart from dividend, they also paid interest. If you remember, we have added this in operating activity. So because it's a non-operating, because it's a financing activity, now we have to take it as outflow. So financing activity is 8,25,000. So let us quickly cross check what are the questions that they are asking. In this case study, there are no investing activities, there are only operating and financing. What is the first question that they are asking? What is the total monetary adjustment for non-cash expenses? There are two non-cash expenses. One is depreciation, another is amortization. So it will be total 5,50,000. Next, coming to the next one. Coming to the next question, what is the cash flow from operating activity? Here we have clearly done cash flow from operating activities 23 lakhs. Next, coming to the financing activity, here we have clearly done how much the financing activity, 8,25,000. And coming to the next question, what is the closing balance? Simple. Here they have given the opening balance. How much is the opening balance? The opening balance is 2,50,000. So here I have done the working for you. Opening is 250, operating activity is 23 lakhs, and financing activity is 8,25,000. So the closing balance will be 33,75,000. So the answer will be 33,75,000. And the last one, once again, a independent question. AR Limited is formed to take over the assets and liability, which is then dissolved. This is a perfect example of external reconstruction, because what happens in external reconstruction is our company will be dissolved and the assets and liabilities of this company will be transferred to a new company. So new company is incorporated or formed to take over the assets and liabilities. Then this company is dissolved. We are not purchasing any other company, whereas our own company, we are just changing the name. We are incorporating a new company. Our assets and liabilities are transferred, then we are dissolved. This is a perfect example of external reconstruction. Hopefully this video will be helpful in cross-checking your answers. If at all you have done any mistakes, you please make sure you don't do that in the next exams. Otherwise, please don't get disappointed. All the very best for the upcoming exams. You can still gain the marks which you have lost in the first paper. Be careful in answering at least part A of the paper. Chalo. See you in the next video.